those saying inflation is over, don't worry. There's 7 more years of it. Kristalina Georgieva, the International Monetary Fund chief, said that there's a risk of more sustained rise in inflation or inflation expectations, which could potentially require an earlier than expected tightening of the U.S. monetary policy. This is after the Fed brought forward its expectations of rate hikes last month. Over the last year, the cost of many products have gone up faster than they have in decades. But even if the inflation surge is temporary, it could raise inflation expectations, and that could have long-term impact on the inflation, interest rates, economic growth, the markets. Except for the period when gasoline prices surged in 2008, inflation is now rising faster than it has in nearly 30 years. The sudden reopening of the economy propelled massive government support, created enormous increases in demand, while supply chain and labor constraints limited output. This classic demand exceeding supply inflationary environment has provided businesses with significant pricing power. Most likely, the current inflation acceleration will moderate over the next year. Businesses will have more time to adjust output, while the government's payments to households and businesses will largely disappear and hopefully moderating sales. Supply and demand hopefully will become more in balance. But that could take years, if not decades. And there's a bigger problem is these expectations. Inflation expectations are what households and businesses believe the rate of inflation will be over time. Expectations of how costs will increase are crucial factors in business and household decision making. If a business thinks its costs will rise by a certain level, it will need to find ways to cover those added expenses. It will look to improve productivity, but also likely lead to a raise in prices. On the household side, inflation affects purchasing power. People can spend their income now or save it and buy goods in the future. The higher the rate of inflation, the less it can be bought in the future. As inflation rises, spending gets shifted from the future to the present. And finally, interest rates could be affected. The rate that financial institutions charge for loans depends in part on the need to offset inflation. Their buying power is negatively affected the same way as households, and they need to cover that potential loss. The higher expected rate of inflation, the higher the loan rate. The implication is that we need to watch out for this current inflation, which is happening, and these expectations are happening over time. The expectations are on the rise. The problem is the government isn't giving people reasons to believe inflation is under control. Aside from making us believe inflation is only 4%, and that's temporary, nothing much has changed. Prices are going up, GDP is going down. The only thing you can do is protect yourself. Re-examine your portfolio, talk to a financial advisor, check out some of these hedges that are out there. Look into gold, look into silver. It's a great hedge right now. Costs of goods are going up. These are goods that people need. These are commodities that people need. So if you believe inflation is here, then you have to believe the prices of gold and silver are going up. If you want to learn more about what we do, give us a call, 877-646-5347. If you're interested in investing in precious metals and you want to talk to a no-hassle representative that has experience in physical metal, give us a call. Phone number is 877-646-5347. Our phone lines are always open, and we're happy to answer any of your questions.